Okay, thanks everybody for joining us. Welcome. It is May 17th, 2017. This is our fifth session of Fuse training on government lending. So it's going to be an exciting one as far as government lending can be exciting. There's going to be a lot of information here, so I think you guys will get something out of this. I know I love talking about it because, as we've talked about in the past, so much of real estate is predicated on finance. Once you understand the finance, once you understand how it works, it gives you a whole different kind of viewpoint and perspective on what you can do real estate-wise. Veterans out there understand it, but sometimes they don't see the nuances and the details that go with finance. And I'm going to try to get into some of those here today. So thank you, everybody, for joining us. I appreciate it. As you can see, Fuse training, we are week 5, Finance 2. Government loans, so government loans encompass pretty much FHA, VA, and USDA. I'll get a little bit into the bond programs of different states. They're kind of similar, but they're kind of different depending on the states that we're in. Advantages, disadvantages, and then I'll kind of touch base on private money loans and what you can use, where and when and how. So there's a lot of different ways to finance a deal. We try to stay away from private money, but sometimes we don't have a choice. So we have to go that route. So I'll give you a little idea about how that works as well. So let's dive into it. So government loans. As many of you guys know, government loans are very popular. A lot of people use them. A lot of people have no choice but to use a government loan. Other people have clear advantages to using a government loan. So, for example, FHA has a lower credit score and they have higher LTVs and they have higher DTIs. So you don't have to put as much money down. You can have a higher debt-to-income ratio, and you have a cruddy credit score. So sometimes you're forced to use that depending on the circumstances of your DTI, your income, and the house you're trying to buy. VA is a great loan. I love VA loans. Veterans are entitled to VA loans. They deserve them. No money down and decent credit scores, but not terrible credit scores. And USDA and VA and USDA are 100% financing. So that's why they're so attractive as well. So let's get into it. I want to kind of start with pricing again. We had talked about pricing last week, but I want to reiterate what pricing is. And so let's dive into that. It's very important to understand how we price loans because, again, part of what we're teaching here and part of the training I want you guys to come away with is that better finance means better real estate. So more purchase power means eliminating closing costs. It means doing so much, you have so much flexibility when you're doing a real estate transaction by understanding what you can do with finance. So let's touch base on that again. I'm going to get into our EASE program. This is our wholesale lending division that we typically go through. I like them. They're out of Michigan. They're very large. They're very convenient. They do a good job. Okay, so let's look at today's rate sheets. We'll start there, and we'll see how the bloodbath on Wall Street is affecting interest rates. It should be affecting them positively. So typically when there's a mess on Wall Street or there's a mess globally, some geopolitical nonsense is going on, that interest rates get better. And the reason they get better is because they're pegged to the bond yield, the 10-year Treasury yield. And when the markets get spooked, for example, when the stock market gets spooked, institutional money pulls out of the stock market and puts it into a safe place, which is the bonds, U.S. Treasury notes. So they put them in there kind of temporarily to see what's happening or weather the storm economically that's out there. And so then it kind of the interest rates get lower as the bond market gets bigger. So we talked about conventional loan products last week, and I'm going to go down here right into the government loans. conventional arms, and government product pricing. Okay, so we'll get into elite and regular. So elite is a little bit better terms, better interest rates. So you can see down here, let's see, get a little bit bigger. So elite government finance. So you've got a minimum FICO score of 680 and a loan size of 175. Okay, so if you have that and you're going FHA, then you get better pricing. So for example, over here, this is the better pricing. Now remember, par, we're off the charts here today. Okay, so right now par is well below 3.25%. Holy smokes, pricing got really good today. Now what this means is we go to the lowest point that's a negative, between a negative and a positive, and that's called par. So, and this is the rebate. That's the percentage rebate you will get on a loan for a specific interest rate chosen. So for example, let's say we have a $300,000 FHA loan in King County. We can do that. And they've got a 680 credit score. It's a $300,000 loan, so it's above 175. This borrower is going to be getting a 2.138% credit for closing costs at the closing table. So that's a $6,414 credit they'll get for that interest rate. And the higher they go in interest rate, the bigger credit they're going to get. This right here is a 30-day lock, if you guys remember that. 15-day lock, 30-day lock, 45-day lock. So this is a lot of money on a $300,000 loan to get $6,414. That's pretty incredible. So that pays for closing costs right there, pretty much. It depends on the time of the year that it closes and a bunch of other factors, taxes, etc. So now we go down to regular FHA. This is getting a little bit closer to par. So we've got 3.375, and it's just a credit of 0.727. So $300,000 loan, credit of 0.727%. That's $2,181 at 3.375% interest rate. This is for a 620 credit score. Anything below that, this company will not do an FHA loan. So that's pretty good too. But let's say you need that 2 points, so 2 points in closing costs. Well, then we would go up to 3.75, and there it is, 2.774. That's a lot of money. $300,000 loan, 2.774% interest rate, $8,322 would be the credit to this borrower. So that's how pricing works. Conversely, if you want to do a buy down, you go down the scale into the positive territory. For example, here on an elite FHA 5-1 ARM, if they came to me and said, I wanted a 2.25% interest rate, I'd say, okay, on a 30-day lock, today that's going to cost you 0.376. So a $300,000 loan, 0.376% is $1,128. So they pay $1,128 up front, and then they get an interest rate of 2.25% for 5 years. I don't really put too many people in ARMs anymore. It's going to be too volatile, and we're too low in the market to think that 5 years from now when they go to refinance that interest rates are going to be better. They're really not going to be. It's a big gamble. Okay, so that's FHA. We'll kind of compare that a little bit now to VA. Whoops, VA is right in, where's VA? VA. Oh, here it is, over on this side. Okay, so there's VA jumbo, VA fixed rate. So here it is right here. So if someone said, hey, what are VA interest rates today? I would say, well, the lowest we can go is 3.5 with this lender with a credit of 0.857 on a 30-day lock to you, to the borrower. Pricing it out, we may be able to go lower than that. I'll have to check some of the pricing models. Now remember, there's adjustments. So whenever we have adjustments to do, we look at state adjusters. There's Washington right there. So there's a 1/4 point. You write that down. 1/4 point there. If the loan amount is under $100,000, there's a hit to that as well. That's 1/2 point. But in this case, it does not apply. Oh, that's right. These guys go down to 640. 640 is the lowest that they'll go, not 620. We do have lenders that'll go much lower. We'll talk about that here in a bit. And there's adjusters for that. So let's say they've got a 660 credit score, then we would do another quarter point adjustment. And investment properties, HUD, 20-year terms. Okay, so no other adjustments there. So a half-point adjustment, I have to factor that in. And if I'm going back up to our regular FHA pricing, I have to find a half point. So I still can do that right there. But instead of being 0.727, it's going to be 0.227 for that 3.375 interest rate. Okay, let me take a break over here, see if we have any questions. No questions so far. Okay, again, remember, if you have a question, go ahead and pop it into the chat room, and Alex will monitor that. He'll let me know what's going on there. Okay, so that's pricing in a nutshell. That's how we price things. And this stuff, like the stock market, is changing every day, all day long. I could refresh this in 15 minutes, and all these numbers could be different. They could be changing. Different lenders have different ways to price stuff out. I'll give you an example. Price My Loan. Easy Qualifier. This is kind of a neat tool right here. We can go in here. We can do, let's say the borrower's name is Hanson, and they want a loan amount of that $300,000. Sales price of, let's see, we'll do 96.5, and we are going to be in Washington. We're going to have to go into King County because it's higher loan limits. County King. Well, primary residence, single family residence, 1 unit. Appraised value is $310,881 for a purchase of a home. Credit score, let's go down to that 660 because there'll be an adjustment there. Borrower paid compensation. Now, with any sort of compensation in the lending world, there's two different ways you can go. Borrower paid, where the borrower pays the loan origination fee and all those fees, or lender paid, where the lender pays those fees. The trade-off is a higher interest rate. So if the lender's paying the fees, they need that higher interest rate in order to compensate the loan officer. I almost always go with borrower paid just because it's a better interest rate, it's a better way to go, and try to get that rebate or yield spread premium to help pay for closing costs. Some ways it's kind of like 6 1/2 dozen the other. You could go either way, and it's just about the same. But when we're quoting someone, we like to go with the lower interest rate and then give them the option of a rebate. So borrower paid, a 30-day lock, full documentation. Conventional, we don't want conventional because we're talking about government. So we're going to do FHA, VA, service type, inactive service member, and use type, first use for a veteran, and financed. So then we hit get quote. Oh, sales price is $310,880. Get quote. Whoops, thought I did this. Active and first use. Try this again. Okay, then it spits out the products that we can use. So VA, funding fee, regular military, and then FHA 30-year fixed. So before I was wondering, off the charts, we couldn't go past 3.375. If we go to 3.25% on this FHA, that's the cost right there, $494.51 to get that interest rate. So I would quote someone 3.375 with a credit of almost $700 for that interest rate. Now here's mortgage insurance. We'll talk about that later. One of the key factors why I try to avoid FHA at all costs. Now VA, pretty similar, 3.375 for a cost of $70. So that's worth it. If I were doing a deal for people, especially if I was doing their real estate, I would say, hey, I'll pay the $70. Let's get you into a 3.375% interest rate. And as you can see over here, no mortgage insurance. So that's pricing. If they say to me, hey, Joe, we saved for our down payment. We're doing an FHA loan. We saved for our down payment. We have 3.5% down, and we don't have a dime extra. We're in this competitive environment here in Seattle or Portland or now even Spokane, and there's going to be 3, 4, 5 bids on this house. We can't ask for closing costs. What should we do? I say, okay, don't worry about it. Here's what we're going to do. We're going to climb the ladder a little bit, and we're going to go up to 3.75% interest rate, and we're going to get you a credit of $6,941 that'll pay for all your closing costs, every dime of it, including reserves or impounds. So that's, I would give them that option and say, okay, if you don't have any other way to pay for it, we can't ask for the seller to pay for it because it's just too competitive environment right now. Let's have the lender pay for the closing costs. And this is how we would do it. So then we kind of price it out and go, okay, 3.75, it's a payment of $1,624. You were at 3.375. That's $1,560. So we're talking about $64 a month roughly in payments to get their closing costs paid for. In a way, they're financing their closing costs over 30 years. So that's one way to do it. Okay. So that's pricing. Let's go back and see if there are any questions. Pricing is really key because this is how we start with a loan, and this is really what gives you your cues as far as how you're going to be presenting an offer, how you're going to shop for a house. You really have to understand the pricing, understand their limits, understand what their options are, and then go do your real estate work. So the two go hand in hand. And again, that's why we call this fuse training. We are fusing together real estate and lending to give you guys, make you guys a better real estate agent. Okay, so that's pricing. I am going to get out of here. And let's see, we're going to go over each of the products here first. So let's go to our dashboard and let's look at loan products. Let me take a sip of water. Okay. So here we go. This is just kind of an overview of different products. So we're going to start with FHA. FHA is it's a department of HUD, Fair Housing Authority, and I'm sorry, Federal Housing Authority, and it's overseen by HUD, and it was designed for people of lesser means to get into their first-time house, or really any house, but it has to be a primary residence. And so they wanted to make it a little bit easier, a little bit more flexible. And it used to be that way, but the mortgage insurance is such a bear right now that it's not a very good product. I try to avoid it at all costs if we can. With this wholesaler, we've got FHA Elite. We kind of saw the really good pricing there at 3.25%. We've got FHA Streamline, which is a streamline refinance. And you can kind of see here, we see FHA Elite, 680 plus credit score, $175,000 loan or more, all fixed terms, so no ARMs, single family primary residence, and that's going to be most of these. Debt to income ratio up to 55%, and that's one of the real keys to FHA, is having a DTI of 55%. As we talked about last week, conventional financing is 43%. So if they're really stretched thin or they really want to buy a little more house, then this is where we go. We say, okay, you know, you can't afford that with a conventional loan, but you might be able to afford it with an FHA loan. Okay, and ARMs, again, we just don't see a whole lot of ARMs right now because the pricing is just not that good, and I really try to talk people out of it, because I know that 3, 5, 7 years from now, interest rates are going to be worse. So if the pricing difference is not a whole lot different, then why bother? Okay, so those are FHA loan products, and then just regular FHA. Regular FHA, now it has loan limits depending on the county that you're in, and you can always go to FHA county limits, just Google that. It'll tell you county by county. So here in Spokane County, we're talking about 275. In King County, it gets up to 400,000-ish, and it just varies from county to county. So again, if you want to know exactly what the loan limit is, the FHA loan limit, Google FHA loan limits by county, and it'll give you a chart there at HUD's website. Okay, so FHA. Now, typically, let's go to guidelines here. Loan products, conventional, ease. Let me get into this. Okay, guidelines. Now the guidelines, we touched base on this a little bit last week. The guidelines can be a bear. It's a lot of information. There's a lot of kind of micro information in there. You know, sometimes it can be exactly the same, but there's an overlay with this lender. You see them right there. There's an overlay versus another lender. So we have to be really careful about how we price loans, and then we have to really scrub these guidelines. Okay, so FHA, there's overlays right here. Let's go ahead and take a look at just a regular FHA fixed matrix. If it will load, we got a lot of people using a lot of computers today, so I apologize for how slow it is. Okay, so FHA fixed, 1 to 4 units right there. So they can go ahead and buy a 4-unit, but it has to be primary residence. Okay, you see that right here, primary residence only. FHA does not do investment properties or second homes, but they will go up to 4 units. So if somebody wants to live in 1 unit and rent out the other 3, they can certainly do that. And the income that they generate from those other 3 units can be used as income qualifying. So for example, they can only use 75% of it, but let's say the 3 units each generate $1,000 a month, that's $3,000. Well, they can use 75% of that. So that's $2,250 that they can use towards their income. LTV, max LTV, loan to value, is 96.5. So again, just real basic, if you have a $100,000 value, you can only borrow $96,500 against that. So 3.5% down. 50% debt to income. If you have credit scores from 640 to 679, anything above 680 and above, you can go up to 55% debt to income ratio. That's pretty extraordinary right there. Rate and term refinance. I don't know anybody that's refinancing into an FHA loan, so that really is unusual to see right now. And cash out refinances, again, just doesn't happen very often, but if they were to cash out and do a refi, 85% LTV is the highest they can go. Basic product parameters. So we see this kind of 1 by 30 late in the last 12 months if FICO is greater than 680 with AUS approval. So otherwise they can't have any 30-day lates on their credit report, but if they have a good credit score, they're allowed 1 30-day late in the last 12 months. And this is just the overlay, this kind of the matrix. Once we get into the real guidelines, it's, there's a lot. So and let's do that. Let's just take a look at it. I don't want to read them all, but I want you to just kind of see how thick they are. Matrix. FHA handbook, overlays. Let's see if that's there. We'll be back shortly. I guess we're not going to go into guidelines. But the guidelines are basically 100 pages of what qualifies, what kind of income qualifies, what kind of jobs qualify, the whole thing. Okay, so FHA. Now, mortgage insurance is the biggest bear when it comes to FHA. It used to be that you had mortgage insurance on an FHA loan. It was about half of what it is right now on a monthly basis. And then when you got to 80% loan to value, when you paid your loan down or the market appreciated and you can show FHA that you had 80% loan to value, that mortgage insurance would drop off. Well, that changed during the Dodd-Frank years. So about 6 years ago, 5 years ago, they changed that to make sure that mortgage insurance was on that loan, attached to that loan for the life of the loan, for 360 months. So, and it's high. They increased it to 0.85%, and then there's a 1.75% upfront mortgage insurance fee. So it's expensive upfront. You can finance that. The good news is you can finance that 1.75% into the loan. So for example, again, a $300,000 loan, 1.75% is $5,250. So that's added to the loan amount, and it's just financed over those 30 years. So that's the upfront, and then it's 0.85% on a monthly basis right now. So 0.85%, $2,550 divided by 12 months, that's $212.50 a month for mortgage insurance. That's a lot of money to pay for mortgage insurance. So that's why I don't like FHA. It's a better interest rate than conventional, but the mortgage insurance is a killer. But sometimes, again, people don't have a choice. So mortgage insurance is just kind of a necessary evil. Now, what is mortgage insurance? Mortgage insurance is effectively just insuring the loan against default. So if the loan defaults, then the lender basically makes a claim against the mortgage insurance company, and they get paid for the loss. So, and that's why it's something that the borrower pays. They're insuring the lenders that they're not going to default on this loan. So pretty simple there, but again, it's expensive for an FHA loan. Okay. Let's see, intended use, we talked about that. We talked about the mortgage insurance. Debt to income on an FHA loan it can go up to 55%. There's no real set number. It's an algorithm that we have to run through direct underwriting to see if we get an approved eligible. So let's say, for example, they have really good income, but they also have bad credit. Their credit score is way down there, 621 or something like that. So I take it to a different lender, and we'd have to run it and see if we get an approved eligible. So there's a lot of different factors in there. You saw the 30-day lates. If they have one of those, that can factor in there as well. And it'll spit out what their debt to income is going to be. So it could be 50%, it could be 55%. It just depends on the borrower. But again, 55% is really, really high. So that's when someone really, they need that house. Let's say they're in an expensive market and they just only have so much income. We can't change the income part of it, so we have to go FHA to get a little more purchase power. The other side of it is on the debt to income. We can go down to different credit scores. We'll kind of talk about that. The credit scores for a lot of FHA loans get way down and dirty. That's another thing. If people just have bad credit, they miss their car payment, they miss their Verizon payments, they're constantly late on their rent, all sorts of different things, then their credit score is going to be very, very low. And we can go all the way down to a 500 credit score for FHA. Now, there's some caveats to that, the overlays that we were talking about. So if they're going to go down to 500 credit score, they need 10% down. Now, we do have lenders that will go down to 580 with just 3.65, I'm sorry, a 96.5% LTV, so 3.5% down. It's pretty junky, but it's not the worst thing. I think the last one I quoted was way down towards 500 credit score with 10% down, and their interest rate was like 3.5%. So it's not that bad. It's just if someone needs it, if they're absolutely in a terrible position and they have an awful credit score and they do have that money, they do have that 10% down. So again, we're talking about the $300,000 loan in Seattle. If they've got $30,000 down, we can do that loan. Optimally, I want to get them up to 580, so they just have to do 3.5% down. And typically, if they've got that $30,000, we'll have them use that to pay off any issues that they have. So it could be a judgment, it could be collections, it could be all sorts of different things. Use the money to clean up their credit and get their score up to 580 or above, and go with a 3.5% down FHA. So yeah, it can get pretty junky. The key is to any scenario you have is to come talk to us. Again, always talk to me, Louis, Brandon, and let's see what we can do with these junky credit scores. Okay, income limitations. So we kind of talked about that a little bit. The income limitations are not too bad with FHA. I want to get into this. If I can get into the guidelines for FHA, that would really help. Let's see, HUD Handbook 4000. I have a feeling this is going to be a long one. So if you ever are having a hard time sleeping, this is the kind of stuff you want to read, guidelines and handbooks from FHA and HUD. So let's see what this guy says. Aha. Okay. Very boring. Superseding policy.
It's not too boring, Joe.
It's not too boring. Doing business with FHA. Okay.
It's interesting.
Yes, isn't it? It's good reading before you go to bed. So we're in 500 pages, 800. I just want to show you how thick it is. So 993. There we go. 993 pages of FHA guidelines. So it's mind-numbing, really, what you can get out of this. So this is the kind of stuff that we have to peruse, and thanks to the Dodd-Frank bill, it changes every month. So there's something on page 772 that changed last month that we weren't advised on. We don't know about it. So it can be a little bit of a bear with the Dodd-Frank bill rolling out different aspects of that legislation every month or every quarter. There's always some little change that they do, and it's been very frustrating. But anyway, so 1,000 pages of HUD handbook. We're not going to get too deep into that because that's just a nightmare. The overlays here for these guys, let's take a look at those. Okay, let me get rid of that. Eligible borrowers, only borrowers with valid Social Security number are allowed. Maximum borrowers, there can be no more than 4 borrowers per loan. Maximum loans, 6 loans per borrower at any one point. That's what I was talking about, approve eligible. If we can get an approve eligible, and we can run that here in the office, then we're good to go. No manual underwriting, so it has to be an approve eligible. So we have to kind of massage it through and make some changes if necessary. Credit scores must have at least 2 reported credit scores. So sometimes we see people with 1 score. That's not going to cut it here. You see 640 FICO as a minimum. Credit history. 3 traditional trade lines with at least 12 months history, or 2 traditional trade lines with 12 months history and a 12-month rental history. So we do a verification of rent, and we go back to the landlord and say, okay, what was the last 12 months history? So we want to make sure that they have paid their rent on time. Mortgage history of credit score is greater than. They allow 1/30. We talked about that. Verification of mortgage, non-acceptable standalone documentation. Okay, debt ratio. Again, 55% if they have better credit score. Otherwise, we're limited to 50%. Verification of employment is not acceptable as a standalone in lieu of pay stub or the equivalent. So we need that pay stub, and we need tax returns. Tax transcripts are not allowed. They actually want the full tax return. Gift funds must be transferred into the borrower prior to closing. Gift funds are pretty generous with FHA. So it can be from a family member, mom, dad, Uncle Fred, Aunt Sally, grandma, grandpa, brother, sister, but also it can be an employer. So that's the one difference with FHA is an employer can give them a gift, give them a bonus, whatever they want to call it, and we just have to document it. Now remember, in finance, in 2017 in finance, we track everything. We track everything. We look at everything. There's nothing hidden. A lot of people are used to kind of loosey-goosey lending rules from years ago. It just doesn't happen today. So we make sure that everything is accounted for. So when it's a gift fund, they're going to look at where it's coming from, the fund amount, and they're going to look at the transfer. Where did it come from? Was it cash? If it's cash, they're not going to allow it. But if it was in, let's say, an investment account or a money market account, they're going to look at that statement from the giftor, and then they're going to look at the bank statement from the giftee and make sure that $10,000 was transferred from one to the other. Okay, so they verify everything. No funny stuff in lending anymore. We don't even try, because underwriters, they're like detectives. They will find out where that money came from. And ineligible properties, lease condos, co-ops, manufactured homes, etc. So those are FHA underwriting overlays. Okay, any questions? Let's take a quick break. All right, no questions. So we will keep moving on. Okay, so that's FHA. Not the best loan in the world. I try to avoid it because there are certainly better government loans out there. So, and we'll go on to the best of them, which is VA. So let's get here into VA. Now, a VA loan is just fantastic. It's 100% financing. Okay, so the borrower doesn't have to come in with anything down. And there's no mortgage insurance. So again, just fantastic. 100% financing, no mortgage insurance, and interest rates that are basically rock bottom. So really, really good financing. But of course, there are some limitations. Now with VA loans, we do have, let's see, we'll look at the matrix here. We do have credit score issues. So 640 is the minimum credit score with this lender. 1 to 4 units. Owner occupied, so again, primary residence, but 100% loan to value. Now, a VA entitlement, what these borrowers need is their VA entitlement. And depending on how long they served or what pay grade they were at, they have a certain number that they're allotted. So you can't just get some corporal that served for just 2 years and he's trying to buy a $600,000 home. He's not going to qualify that. He's going to have a limit of probably 180,000, something like that. But certainly if you get a full bird colonel that served for 20 years and had a certain salary, he's going to have a VA limit much, much higher. So it does depend on how they served and what their rank was and what their pay grade was. And that's their entitlement. So we get their entitlement letter, DD 214, which is their eligibility, and shows us exactly what they're eligible for. Okay. Now, some things with VA. Again, there's no mortgage insurance with a VA loan, so that's great, but there is a funding fee up front. And it depends on when they're using it. A veteran can use a VA loan multiple times. But the first time they use it, they have I think it's a 2.25% funding fee. Subsequent times that they use it, it's a higher fee. So if they're buying their third home and they're using a third VA loan, it's going to be more like a 3% funding fee up front. And again, you can finance that into the loan. You don't have to come up with it out of pocket. But it can be substantial. You know, if they are in a high-priced area, and again, it's a $300,000 loan with a 3% funding fee, you're talking about $9,000. It's a lot of money. But again, 100% financing, they can't get better than that. Okay, no manufactured homes. And these overlays, 130 by late in last 12 months if you have a 680 score or above, and 55% debt to income. Now, VA doesn't put a debt to income limit on their loans, but this overlay with this lender, they've limited it to 55%. Maximum loan amount for refinances. Okay, a little bit on refinances. I mean, we don't really care so much about that because we're in the real estate industry. We want to purchase houses, but if they ever do want to refinance, they can cash out now to 100% as well. So it's a great loan whether you're purchasing or refinancing. Okay. Keith has a question, I see.
Yeah.
Not with this lender, Keith. There are other lenders that'll do a manufactured home, but again, this is an overlay with just this lender. So, but they will do if it's 20 years or newer and it's affixed to the foundation, it is part of the real property. Then yes, there are lenders who will do a VA loan. And again, these overlays, they just vary. Every lender's different. So when we shop for a loan, we're really looking at, okay, how, what are the parameters of the borrower? What are they looking for? And then we kind of go, okay, well, United Wholesale is not going to be the right choice because they've got a 638 credit score and they're looking for a manufactured home. So we would go to some other lenders and find that. Typically, other lenders will go down to 620. And they'll do manufactured homes, just not this one. But these guys are really clean. That's why I use them and I like them, because if you do fall into their parameters, they get loans done very, very quickly, and they're easy to work with.
Hey, Joe, I had a question sent to me. How do you get the information if you're listing a house? How would you get the information to the buyers? How could lending affect a potential buyer if you're the listing agent?
Well, and if you're the listing agent, I mean, a lot of times, we touched on this last week, a lot of times you just become dependent on that pre-qualification or pre-approval letter. It really depends on how thoroughly the loan officer has done that pre-approval. If they've really, really gotten into the meat of the documents, meaning the tax returns and the pay stubs and the bank statements and the investment statements and the W-2s and all their financial information, where they can really get into it and then take it even another step, running it DU. So if we have a borrower that's going to come into the office and bring all that paperwork and allow us to run their credit and run DU, then we know we've got an answer. We basically, that's it. That's the answer. They just have to stay within those purchase parameters. So
I think the question was more so if a buyer's agent comes in with their buyer and that buyer has a particular lender, the only way that you could probably massage this is if you brought in the buyer and double-sided it. Is that kind of that was the question that was asked to me privately on the chat?
If they're bringing in a buyer, I mean, part of it is getting them to understand, their lender understand what they're trying to do, and again, being able to apply some of these credits, this yield spread premium, these rebates, and then just interest rate. To be honest with you, we have the lowest interest rate in America. We know it because we set it up this way. We wanted to make sure that we were able to do some of these things that other lenders can't or won't. Now, rule of thumb is typically banks won't do this. Other mortgage brokers certainly can. They can apply a rebate towards your closing costs. They can get the interest rate a little bit lower to give you more purchase power. But effectively, you're going to have to get them to compare loans, what they have right now, to us. That's the smartest thing to do, and just go, hey, okay, these guys are saying that this is our interest rate at 3 3/4, and they're not going to give us any rebate at all towards closing costs. Then you go, okay, Joe, what can K-loans do? Well, we can do 3.5%, and we'll give a $4,000 credit towards closing costs. So we've got closing costs mostly taken care of, and we've got a lower interest rate. So it's really key to make sure they compare. Now, will everybody do that? Not at all. I mean, I ran into this weekend where we were a half point better in interest rates, and this guy's like, well, my friend works at Wells Fargo, so I really have to do my loan through them. And he knew he was getting hosed by Wells Fargo, but Wells Fargo would not make the adjustments that we were making. They wouldn't match what we're doing. That's just kind of the way it goes. Big banks are pretty strict about what they do because they make so much money on these loans. So it depends on each borrower. Again, last week we had a few people switch from the lender they were talking to us. And they compared, and we're very open about our numbers. And oftentimes I'll tell and borrowers, go take the good faith estimate I give and get your lender to match it. They don't have to beat it, just match it or come close, just to make sure that our clients get the best deal. But again, it helps us as real estate professionals because the more money they can borrow, the higher in price they can go. So in a competitive situation, they can go a little bit higher on that escalation clause and get a little bit more money out of that and make a little bit higher offer. Or again, you can't ask for closing costs in this competitive market, so they can take care of their closing costs through the lending side of it. Hopefully that answered your question. You can always email me offline or send me a text, and we'll try to answer your questions as soon as we get them. Okay, so VA loans, we talked about that funding fee. It's a little bit higher, and subsequently it gets higher and higher the more times you use it, but you can use it multiple times. Income limitations with VA, again, it's not so much an income limitation as it is a restriction on what they're entitled to. So a DD 214 and their entitlement letter is really important. Okay, that's primarily it for VA loans. I should go back on and let me see here. Let me go look at my overlays. Advantages, USDA. Okay, we'll get into USDA next. So a USDA loan, so we saw FHA loans are just for low income or borrowers who just don't usually qualify for lending. They're a little more lenient in their guidelines. VA loans, obviously for a veteran or reservist. And then USDA is for rural development, so buying a house in a rural area. Now there's some nuances to USDA that I find really, really interesting. The rural map, the rural development areas are sometimes right in the heart of cities. Maybe not in the heart of the city, but they're very close to the metro area. So it's 100% financing. It's intended to basically develop and get people to move out to rural areas. It's a good loan, but there's a lot of kind of small nuances to it, and we'll go over that. But yeah, if you can get someone, if they didn't serve in the military and they want 100% financing, there's a way they can do that with a USDA loan, and they don't have to move out into the sticks. They can really get into just traditionally what are suburbs. There's income limitations, and there's some other stuff too that we'll go over. So let's see. Let me get rid of that. Okay, so USDA. Here it says max 102% loan to value. So that's just basically financing in the guarantee fee. Okay, and minimum credit score is 640. So all these government loans, United Wholesale is only doing 640. Maximum 424,100. That's a conventional loan amount. 30-year fixed, no buy downs. One family, so 2 to 4 family units, a fourplex or a duplex, are not eligible with USDA. No cash out. You're not eligible to cash out either. So household income, it's kind of an interesting guideline there. Let me take a look at that. Single guaranteed program, Washington. Okay. So this is Washington, and you can see it goes by certain areas. There's Bellingham, there's Longview, there's Olympia, there's the Portland, Vancouver area, and it goes by 1 person, 2 person, 3, 4, 5, 6 person households. So if you are in Bellingham, Washington, and you have 2 parents and 4 kids, then you qualify for $106,000 income. You can't go over that to do the USDA guaranteed loan program. Okay, and then so on and so forth. Spokane, it's 105,000, and Tacoma is 113,000, and so on and so forth. Yakima, let's see where. Let's see where Seattle falls. Did I miss that? Jefferson, Island, Great Ferry, Yakima, Wenatchee, Spokane, Seattle, Bellevue. There we go. 136. So a family of 6 is 136,000. A family of 4, 2 parents, let's say a nuclear family with 2 kids, 103,500. So that's their limit. That's a lot of money. So you really have to make a ton of money to not qualify for USDA. So that's the income limitations, and you can always check that on the USDA website as income eligibility right there. Okay. Now, let's go over to property eligibility. This is kind of a cool map. So if you're ever trying to figure out USDA property eligibility, bam, here it is. This great interactive map. And you'll see from this that it's just kind of crazy, some of the areas. Now, this really affects people when they're selling as well. So there's a neighborhood near me here in Spokane that crosses the USDA line. And so I tell people that are thinking about listing a house, it's like, look, this is a great house to list, a great area to list in, because we can market this as 100% financeable, as USDA financeable, and it's right in the city practically, and it's hooked up to sewers and got all the facilities right there. So let me show you that. And so you kind of see the map here in Spokane. So I live way here on the south side, but here's 57th. Now, on the south side of 57th, this is all just kind of city. I mean, there's lots of restaurants right here, Regal. There's grocery stores and restaurants and banks and all sorts of stuff. So everything in this light area, these thousands of houses here, all qualify for USDA financing. But on the north side of 57th, it doesn't. So if someone has a little house here on Napa, on 58th and Napa, that qualifies for 100% financing USDA. So a lot of times there's little nooks and crannies that are very close to metro areas. Here out in Idaho, you know, Post Falls, this entire Post Falls area qualifies for USDA. East of Spokane, Otis Orchards, Newman Lake, Liberty Lake even, of all places, qualifies. Look at that. So Liberty Lake, there's lots of houses in here, and that's all USDA country. If we look at Seattle, I had a friend that was trying to buy a house, didn't make a lot of money, didn't have any money down, and I said, well, he lives on the south side, Renton, Kent area, and I said, look, we've got to go past Maple Valley. So, but on this side, on the east side of Maple Valley, there are a ton of houses. And down here on 216th, 224th, I mean, so just being on this side of the highway, you can buy a house for 100% financing. Or you can go up here to Carnation, Fall City, so Duval. So all these houses out here in the suburbs, they all qualify for 100% financing. Vashon Island and Bainbridge Island, they both qualify for 100% financing. Go down here to Portland, you know, just down here in Wilsonville. I mean, Wilsonville's practically the city still. So down here, we're talking about 100% financing. And out here past Happy Valley, Wilson Corner. So there's a lot of good houses out there. You can certainly find stuff. I mean, it might not be optimal if someone wants to go all bohemian and live right in the heart of Portland and do that whole Portland thing, Portlandia thing. Well, no, they're not going to get USDA financing. But if they want to buy a little house outside of Portland, very close in the metro area, they certainly can. They just have to be a little bit flexible. So this is the map you look at to figure out if you qualify USDA. In certain areas, like here's Longview, you know, that doesn't qualify in the heart of Longview, but Kelso does over here, and so on and so forth. The Tri-Cities, you know, you've got a lot of homes out here on this side of Highway 82. They all qualify for USDA financing, so on and so forth. So here's the eligibility map. Just go to USDA's website and type in eligibility, and it'll give you that map so you can kind of search it on your own. Okay, let's go back to our USDA qualifying. Okay, let's do a qualifying scenario here with Hanson. So let's go down. We'll do a $150,000 loan. We will do a sales price of. Oh, she's loading. No, hopefully we're not locked up.
I can still hear you. Can you hear me?
I can hear you, yeah. It's just for some reason I got locked up here.
Oh, I got you.
Yeah.
Do VA loans take longer to close? Did you catch that one?
Oh, I didn't. VA loans can take longer to close. That's a good segue while we're waiting for this. Actually, you know what? I'm going to just get there. You have to be a certain kind of appraiser to do a VA loan, and same with an FHA loan or USDA. You have to be qualified to do these loans, and it does take longer depending on the area. So, for example, I know Portland's really behind, and there's very few VA appraisers there, so it can take 4 to 6 weeks. FHA, not quite as long, but can take 2 to 3 weeks. And so you really have to find the right appraiser, and you have to set expectations right. A lot of times people, we'll go back to Quicken Loans and these rocket mortgages. So they say, okay, push button, get loan. Well, it doesn't work that way. You push button, you start the loan process, and you get that DU, approve eligible. So they pull credit, they pull tax transcripts, and they kind of wash it all out instantly. And that part's fine, but then all of a sudden you have to get into the actual meat of the loan, and that's ordering a VA appraisal. And that's where it could take a month, and you just can't make it go any faster. We don't have any communication with the appraisers. We have to go through the appraisal management company. They're not beholden to us in any way, so they basically just do what they want when they want, and to hell with everybody else. So yes, it can take a while. That's probably the most frustrating part of a VA loan, is the VA appraisal process. So yeah, we just kind of all have to deal with it in that regard. So let's see. So property location restricted to the map, age of documents, all within 120 days. First-time home buyer. So home buyer counseling is required in Georgia and South Carolina. Eligible borrowers, U.S. citizens and permanent resident aliens. Closing costs can be financed in the loan amount if there's room and the appraised value over the purchase price. So again, that's what the 102% is right there, LTV. So if it's $100,000 and it appraises at $100,000, you can go to $102,000, but no more. Must receive that approve eligible and guaranteed underwriting system. That's the government underwriting system. Bankruptcy foreclosures, 36-month waiting period, 130 by late if you have a 680 credit score or more. CAVRs must be clear. So that's let me talk about CAVRs a little bit. So CAVRs is the federal numbering system, and it attaches a number to a house. So whether it's FHA or USDA, we have to order that FHA case number, which is the CAVR number, and only one number per house. And so if you're trying to buy that house, we've got to get that CAVR number established right away. So that's one of the things that can also delay a loan for these government loans. So that's one part that happens almost immediately. And then all delinquent federal debt must be paid. So yeah, it's very important that any sort of IRS liens or anything like that is taken care of. Federal student loans, things like that, they're taken care of before a CAVRs number is going to be issued. Income and employment, 2-year work history with pay stubs, earnings for the most recent 30 days, W-2s for the last 2 years. Self-employed, at least 2 years, and 1 year in the same line of work from previous employment. Mortgage credit certificates not available. Debt to income ratios as approved. Okay, so they're not telling us what the DTI is, it's just the approval, but typically 50% is going to be the maximum. Seller contribution 6%. Ah, good. I'm glad we ran into that. So with any government loan, the seller contribution can go up to 6%. Okay, so conventional loans were limited to 3% seller contribution. But with FHA, VA, and USDA, we can go up to 6% seller contribution. Not that you would need it, but sometimes, I mean, if it's a really cheap house, if you're talking about a $100,000 loan, you might need $4,500 in closing costs, so that's 4.5%. So it does help for those lower loan amounts, but the higher loan amounts, not really. Owner-occupied, of course. Appraisals cannot be transferred from other lenders. They need to be from an approved AMC, appraisal management company. Private wells must be tested. Septic not eligible in flood zones. Septic inspections only if required by the appraiser. Okay, so that's the USDA kind of overlays. And again, it just depends on the appraiser and how fast you can get an appraiser out there. Now, with all these government loans, there's a one real important feature, I think most of you recognize this, is that it has to be eligible property. And an eligible property primarily means that it qualifies, let's see, everything's in working order. There's no peeling paint. There's a cooking unit that works fine. Heating, ventilation, all works well. No cracked windows. Basically, it just has to be in good order. So they don't want to lend on anything that's going to be trashed. Peeling paint's the one that comes up the most. So if you're walking around a house and you're like, okay, are we going to be able to finance this, or is a borrower going to be able to finance this with FHA or VA money? What do we have to do to get it to qualify for that? And that means, you know, painting it, maybe scraping away some of the peeling paint around windows and just giving it a once over. I've even seen people just put on primer, not even the paint, just put on the primer and say, okay, it's primed, and then you can paint it after you buy it. But the appraiser just can't see any of that peeling paint, and that includes detached garage. A lot of people think that the detached garage can be falling down and the house is in really good shape. They're going to call out that garage as well. So garages have to be in good shape. The roof on the garage has to be in good shape, has to have at least a 5-year life expectancy. So you want to make sure that the roof is okay, that nothing is sagging, that there's no mold, there's no peeling paint, the windows are all intact, none of them are broken, that the furnace is working well, that the cooking unit's working well, that everything's working well. Even the electricity, some appraisers, they'll test the polarity on the receptacles. So you want to make sure it's in good shape, but it doesn't have to be in perfect shape. Just remember that. It has to be in decent shape. And again, peeling paint's the worst one. So someone trying to sell a house and they've got peeling paint all over the windows, it behooves them to go out there and spend a weekend just scraping and painting.
Disconnected.
Are you?
Yeah. I figured it out.
Okay. Alex tells me we are disconnected. So hopefully you guys can you can all hear me still. Let's see what it's saying here. Okay. Connecting to audio. Huh. Technical difficulties today. Keith Bow has arrived. Webcam is back online. Come on, audio. Network connection has been reestablished. Okay. Come on. Trying to reestablish audio. Connecting. Let's see if we can do that. Okay.
Muted.
Muted?
Unmuted.
There we go. Okay, I think we're back. Just make sure everyone's still in attendance. Okay, can you guys let me know if you hear me now? Donna says yes. Okay. Yeah, that was the first time we've experienced that, so my apologies. Hopefully you all took a break. And we are back online. Okay. Let's see, where were we? Oh, we were talking about appraisals. That's it. Okay, so I'll start over on the appraisals. Yeah, we're back on. Okay. So the appraisals, government appraisals are, they're a little bit different because they do scrutinize the property a little bit more. I don't know when we dropped off, but we'll just kind of go over this again. Oh, I also want to make sure we are recording. Yes, we are. Okay. So government appraisals are a little bit more stringent because usually it's the peeling paint. Everything has to be in working condition. So no peeling paint, the windows can't be cracked, the utilities have to be working properly, the roof has to be in good shape, at least good enough to last another 5 years. And cooking equipment, flooring has to be down. Now, a good example, let's take flooring for example. If you have subfloor and you paint it with an enamel paint, well then it's covered, okay? So you don't have to have just carpeting or have just wood flooring or whatever other kind of flooring, vinyl. You can actually paint it with an enamel paint. You know, sometimes we see houses that have, they've been kind of cleaned out a little bit. They don't have a range on them, and the range is the only one that you have to have. So sometimes just go to a ding and dent center and just get a $300 oven stove, put that in and make sure it's working. Sometimes there's a cracked window pane somewhere. You got to take care of that. But all those things are pretty standard and pretty, you know, just common sense. So take a look at the property. The one we run into 99% of the time is the peeling paint. And again, if you have that peeling paint, yeah, outlet covers, peeling paint, handrails, that's right, Keith. All that stuff has to be, the safety aspect of the house has to be intact. So handrails, the polarity on the outlets as well, they'll make sure that it's not going to burn down, and make sure that everything is wired properly, the best they can anyway. Appraisers are not inspectors, but they are certified to do government appraisals, so they are taught how to look for these 5 or 6 different things. But when you run into the peeling paint on the garage, detached garage, anything like that on the house, just scrape it, put a little Kills on it, a little bit of primer maybe, just seal it. It doesn't have to have this perfect paint job, but it has to be enough so that it's sealed so that when they come back and re-inspect the house, they can see that, okay, it's been taken care of. And then if you are going to scrape it, make sure you scrape it onto a tarp and then kind of clean it up. They don't want to see peeling paint chips in the bushes. So there's a little bit of work to do, but you know, if you get a seller that has some of those issues, just say to them, hey, look, in order for us to attract these FHA buyers or these VA buyers, we want to make sure that these things are taken care of. And some people just don't want to do it, you know. And I've done this before where I've had a client and we have a VA buyer, let's say, and it just takes 2 or 3 windows just need to be cleaned up and painted. I've gone out and done it myself. I'm like, well, I'm not going to forego a $7,000 or $8,000 commission, and all I have to do is spend 2 hours just kind of fixing up, touching up these windows. So I've actually done it myself with obstinate sellers that won't do it. But it's up to you guys how you want to do it, but that stuff has to be taken care of. And again, the appraisals can take forever, and so it's not just getting the appraiser out there the first time. Then if they call something out, they have to re-inspect. And it's usually about $100 more. They come out, you know, 2 or 3 weeks more. Again, these guys, sometimes they are so, they're so busy, at least they claim they're so busy, or they're so far away that they're just not willing to come back out in a timely manner. So you really have to set expectations right when you're dealing with a government appraisal. It can take a long time to get done. And sometimes it's really fast. You just never know what you're going to get. It's like a box of chocolates, Alex. You just never know what you're going to get. So these appraisers can be all over the place. Okay.
Very true.
Very true, indeed. Okay, guidelines, price my loan. We really don't, let's see, I'm going to go back to loan products and get into USDA because we haven't done that here. Okay, so 100% financing, USDA, you guys have seen the map, the eligibility map. If they qualify for that and their income is within the income eligibility parameters, then they're all set to buy a home 100%. 30-year fix, no down payment required, no cash reserves needed. That's nice. Closing costs may be financed on some transactions. Seller contributions allowed, again, up to 6%. And the interest rates are right in there with other government rates. They're pretty good. USDA might be a little bit higher, but not a whole lot. So then helpful USDA links, the USDA Rural Development homepage, eligibility site, all that stuff is on the USDA website. Okay, let's take a look at rate sheets. See if we can, now what's going on here? Products, these. We are logged in, price my loan, rates. Let's try this again. There we go. Okay. Conventional. Conventional arms. Government pricing. USDA, here we are. Go down here so you can kind of see the pricing. Okay, so you can see USDA pricing. Actually, it's very good, very good. So 3.25%. There's actually a credit of 0.288 on a 30-day lock. So really good pricing. If someone asked me what is USDA pricing, I would say 3.25% today. Okay, so really good pricing there. Again, a very good loan product, but a lot of people just don't use it because they don't really know where the eligibility starts and stops. So use that USDA map because it's a really, really good loan to use if you qualify. Okay, let's see. We have looked at a whole lot of stuff here. I'm gonna close down some of these things. Let's close down that. USDA matrix, we've seen that. Now let's take a look at our schedule here. Okay, state bond programs. First, does anyone have any questions about FHA, VA, USDA products? No? Okay. Take a sip of water and tea. I got them both right here. All right, state bond programs. Let's just touch on it in a general sense because every state is different. So the state bond programs is basically funded by the state, whether it's Oregon, Idaho, Washington, Florida. Every state has some sort of bond program. And effectively what it is a second mortgage on top of your first. So let's say, for example, here in Washington, you get an FHA first at 96.5% loan to value. And then the 3.5% second is financed by the state of Washington. And there's income parameters around that. And then you have to be a lender that qualifies for the bond program. And it's quite a process to go through. We're actually trying to go through that process. It's taken about 1.5 years, and we're still not there, but we're getting closer. So we are not eligible for the bond program. But again, we've got USDA and VA as 100% loans, and we've got our conventional product, which is 1% down. So, and here's the real difference, because a lot of people are like, wow, 100% financing, fantastic, I want to do that. Well, yes and no. You kind of want to do it, but at the same time, it's a much higher interest rate. So the bond program, the 3.5% down second, can be really cheap. That can be like a 1% interest rate. It's the FHA first, that becomes much higher, like 4.5% to 5% interest rate. And normally that would be 3.25%, 3 3/8. So you're talking about a much, much higher interest rate for the state to do this program. So I try to find out from borrowers, why 100%, what their issues are, if they can borrow the down payment. Again, that 1% down is a better program than the bond program, because they're still dealing with FHA mortgage insurance and a much higher interest rate for the FHA loan. But if that's what they need and they have no money to put down, then great. The bond program, they want to live in the city. Again, they want to be all bohemian and live in the heart of Seattle or Portland. Then they don't qualify, they didn't serve in the military, then this is their only 100% option. And it basically closes, a second loan closes simultaneously with the first loan at escrow. So it takes a little bit longer to make sure that all the ducks are in a row with the state bond program and the lender working with the state, in addition to that first mortgage that is a federal loan. So federal loan and then a state loan second. It's not, it's not a bad program. I think sometimes people just don't recognize the high interest rate, which, also means a higher mortgage insurance payment, and it's not my favorite loan. So I know a lot of people talk about the bond program, but there are better loans out there, I believe. But sometimes, again, you don't have any options. So that's the bond program. If you ever have a question on that, let me know or let Louis know. We'll direct you to some of the better lenders out there. There are some lenders who they just don't care. I'm not that impressed with them. And because you don't make very much money on these government bond programs, a lot of loan officers just don't care, and they'll treat the loan with less emphasis than they would for a bigger loan that they make more money on. So just remember that. It can take a little bit longer. And again, anything that moves away from a vanilla loan, you've got a doctor with 20% down and perfect credit and lots of reserves and everything. I mean, yes, those loans can move through the system very fast. You close one in 9 days. But as you move away from that and it gets junkier, then it takes longer. Whether it's a government loan, income issues, credit issues, it just depends. So anything that's kind of outside the norm, typically it could take a little bit longer. So just remember that as you're doing some of these programs. Okay, now government appraisals and how they differ. We had talked about that, so I think we covered that fairly thoroughly. Yeah, they're a little bit more stringent on those appraisals, so be careful, and then also account for the time it's going to take to get that appraisal through. So you don't want to just say, hey, let's do a 3-week closing when you know it's going to be a VA or FHA loan. You want to give it at least, I would say, 45 days for a close. You can always do 45 days or sooner. So I know this is a very competitive market, so when you're dealing with cash offers as well, they're like, hey, we'll close this in a week. And so it's hard to compete with that. But say or sooner, that we're going to try our very, very best to move it along as fast as we can. And that means with any of these loans, the better you start out. So if you sit down, you'll see you sign around a contract. The next step is coming into the loan officer's office, sit down with all that documentation and make sure they've got everything they need so that they can submit it right away. Get it into the lender, get it into underwriting. Once it's in underwriting, then you can order the inspection. Once you order the inspection and everything looks clean there, then order the appraisal. So that first week is really, really critical to getting all that documentation in and getting things rolling. Even that first day, when everything is signed around, you got to get everything to escrow. You got to get the earnest money receipt. You got to get the inspection ordered. You got to get the loan documentation set up and in with the lender in underwriting. And again, you don't want to order the appraisal until the inspection is completed, because what happens if the inspection finds just a ton of issues and you want to walk away from the house? Well, you don't want to spend $500 on the appraisal. You're not going to get that money back. So make sure you start everything off that very next day after you've got a signed around document. Okay, so the advantages and disadvantages to all this. We've touched on most of those. Again, I think the best loan out there is the VA loan. A VA loan is great. Sometimes this guy, Dave Ramsey, that talks about money and how to manage your finances, he always bags on VA loans, and I don't think he knows really what VA loans entail. So You know, with 100% financing, I think that's his gig, is that it's 100% financing, and you always should put money down. You should have skin in the game. But you know what? From a veteran's perspective, not putting any money down and financing 100% of it with no mortgage insurance at a low interest rate, I mean, how do you get better than that? So I really like the VA loan the best. USDA obviously is a very good loan, but it's got the eligibility issues, whether it's income or whether, more importantly, the restrictions based on the location of the house. So you've got those map restrictions you really got to pay attention to. And then an FHA loan is probably the junkiest. It's just, it's not a loan that I like going into. Unfortunately, we do a lot of them because people have junky credit. They just mess up. And what's amazing is the little things they do. They don't, you know, I get it if you have a bankruptcy. I get it if, you know, you have a massive disease and life falls apart and stuff like that. But we see the vast majority of people just not making their Verizon payment. They just, you know, they're mad at Comcast, and Comcast billed them for HBO, and they're not going to pay the $30. So they're going to dig in, and guess what? The Comcast is going to win, because they're going to report it to the credit reporting agencies, and then all of a sudden you've got late payments, and your credit goes down 100 points because you didn't want to make a Comcast cable bill payment. So there's a lot of issues out there with credit, and ultimately, it's, when we get to this point, it's like, hey, look, Mr. Buyer, all you qualify for is FHA, and you're going to be paying this $200 a month mortgage insurance for the life of the loan. Well, let's take that number and multiply it. So $224,000 a year times 30 years, that's $72,000 that they're going to pay in mortgage insurance because they failed to make their $30 Comcast payment or their AT&T bill. So we see a lot of telecommunication issues on credit reports, you know, or they didn't make their last rent payment. You know, whatever it's going to be, is they mismanage their money to the tune of hundreds of dollars, and they end up paying $72,000 in mortgage insurance because of it. So, you know, the smart ones take care of their credit, take care of it religiously, and that way they always have the best options for financing. Okay, private money loans. So a lot of times you can't, you don't qualify for any of these programs. And I'm going to show you a resource that's really good for private money. Now, private money is really expensive. It's one of those things where we're talking about, you know, 5 points up front. If you're doing a $200,000 loan, well, 5 points is $10,000 up front, and a 10, 11, 12% interest rate for a year or 6 months, or you know, it's a short term. So these are effectively loan sharks, legal loan sharks, and you want to avoid this at all costs, but sometimes people have no choice, especially if they've got a really good deal. This may be just a totally beat up property that they want to flip, or an apartment building that's unfinanceable, whatever it's going to be. So the resource is the Scotsman Guide. So the Scotsman Guide is a it's just a great resource, especially for commercial finance and hard money, but residential as well. So you can do lender search, okay? And there's correspondent, there's warehouse, there's niches here, FHA, VA, government, prime first, non-prime first mortgages, and hard money and construction money. Now the matrices that they have, they cover the whole country. So for example, you'd go down here and you'd go Washington, loan amount $300,000. Non-owner occupied, single family residence, purchase, loan term for 24 months, an LTV of 90, let's say. Search. Resulted in 0 matches. The problem with that is the 90%. That's they're not going to like that. So let's go, or even the 300,000. They don't like small money loans. So if we do 500,000, and we do 2 to 4 units, and we do 75%, search. 5 matches. So here are the grids you can go off of. So these all do business in Washington State, and they all have these $50,000, in this case, $50,000 minimum, 75% LTV, 360-month amortization, and these little yeses, yeses, yeses are all these numbers up here. So owner-occupied, non-owner-occupied, builders and developers, legal entities, foreign nationals sometimes. Sometimes you just get really goofy, junky stuff and you need something. There's manufactured homes is number 16. So we'd go to 16 and go, oh, they don't do it. None of these companies will do a manufactured home here. Let's see, what is another one? Condominiums, loan characteristics, purchase, blanket loans, bridge loans, 24. There you go. They'll all do bridge loans. So sometimes that's required, and so on and so forth. So if you ever need, the point is, if you ever need something junky, if FHA is not working, or VA is not working, or USDA is not working, conforming is not working, you just have a hard time finding a loan for a borrower, look at the Scotsman guide. So Scotsman with 1 T guide, and they've got everything in here, commercial as well. It's really a good source for commercial more than anything. So you can get into this lender search for commercial. It could be Washington LTV, let's say 80. Debt service coverage ratio, that's kind of like a cap rate, but we'll say 1 in that case. A purchase, and we'll say office building. Let's see if anyone will do an office building. A loan amount, $1 million. Okay, 8 matches. So here we go. Maximum is $2 million for RCN Capital. Loan to value, 85%. South End Capital, they'll do 90%, so just 10% down on an office building. $1 million office building, $200,000 down, you can get it done. And they'll do also all this other stuff: medical, a hospital, mixed use, energy production, so churches, synagogues. Remember, you guys can all do commercial real estate. You're licensed to sell the Space Needle if you want, as long as you're licensed in Washington. So it's not just for commercial brokers. If you ever have someone that wants to sell a multifamily, an apartment building, or a gas station, something like that, just give me a call. We'll kind of walk you through this. But as far as finance goes and hard money and lenders for commercial properties, this is where you go, the Scotsman Guide. Any questions? Alex is back. Okay. Good. All right. Well, let's finish up here. Oh, I guess we did finish up. Private money loans. I can't think really of anything else to talk about on this. I've covered my list. Are there any questions out there, any situations you guys have run into, any issues that you've heard about? So let's do our Q&A now. I'm going to unmute everybody. I'll unmute other people. I think that's right. Yeah. Send unmute request. Keith, send unmute request. Jennifer, Elda, Donna. Okay. Webb, Keith. Use agenda. Is there a list of USDA stuff that one can get to check off on a home? Keith, you'd have to go to the USDA website. They'll give you some of the parameters, but I mean it's really the normal issues: that peeling paint, cracked windows, roof, siding, making sure that everything's in good working order and functioning properly. So that's primarily the rule of thumb. And that's effectively what the appraisers are looking for. They'll look for mold as well. They'll call out anything if they think it's going to be a hazard. Okay, so it doesn't look like there are any questions. Of course, you guys can always contact me directly. You can email me, give me a call, text me with certain situations and always certain scenarios. So if you have somebody that's interested in financing, and especially in these difficult markets where you've got competing offers, talk to me. Let me kind of go over their situation, see if we can't boost up their purchase power a little bit for the same payment, or take care of closing costs with this rebate, this yield spread premium the lender will pay, and let's see if we can't get them a better interest rate at the same time. So there's a lot of power in finance, and so it's not just the program. It is about getting the best interest rate and doing the best job for your clients. That's really what this is about. And by doing that, you'll actually get more business and more referrals from them. So we're always here to qualify. Louis is on the road, but he's available right now to qualify. Brandon can qualify people. I can qualify people. So any questions that you have, always just shoot me an email and we'll see what we can do. Okay, thank you everybody for joining us. It was a little bit shorter training, but that's good. Gives us more time to go out there and sell. Hopefully it's not too wet and rainy where you are like it is here. Springtime is around the corner. Okay, thanks all. I'm going to sign off and have a very good Wednesday.